The ideation process is the mental journey that turns a vague curiosity into a clear business concept. Think of it as a kitchen recipe. Gather ingredients, collect observations, trends, personal frustrations, and technology news. Mix and match, combine unrelated pieces, for example, a smartphone sensor, plus the need for faster medical diagnostics. Taste test, ask friends, mentors, or potential users for quick feedback. Refine, keep what sparks excitement, discard the rest. Two broad categories of ideas emerge. Breakthrough, disruptive ideas create a whole new market or radically change an existing one. Example, the first iPhone turned phones from calling tools into pocket computers. These ideas often rely on a new technology, a novel business model, or a dramatic cost advantage. Incremental ideas improve something that already exists. Example, a new fitness app that adds a social challenge feature to an existing platform. Incremental ideas are usually easier to execute, need less capital, and carry lower risk, but they also generate smaller upside. When deciding which path to follow, ask, do I have access to a unique technology or insight breakthrough? Can I quickly prototype and test a modest improvement? Incremental. Both paths are valid for MBA students. The key is to match the idea type with your resources, risk appetite, and time horizon. Explanation: opportunity identification frameworks problem solution fit jobs to be done parenthesis. Two powerful lenses help you see if a market need really exists. 1. Problem solution fit. Step 1 – define the problem – write a one-sentence statement of the pain point. Example, urban commuters waste 30 minutes daily searching for parking. Step 2 – validate the pain – conduct 5 to 10 short interviews asking how often the problem occurs, how much it costs, and how they currently cope. Look for consistent quantifiable distress. Step 3 – sketch a solution – describe your proposed fix in plain language. Example, a mobile app that reserves a parking spot in advance. Step 4 – test the fit – show a prototype or storyboard to the same interviewees. If at least 60% say they would use or pay for it, you have a decent problem solution fit. 2. Jobs to be done parenthesis JTBD close parenthesis. This framework treats customers as hiring a product to get a job done. The classic format is when situation, I want to motivation, so I can desired outcome. Example, when I am late for work, I want a quick way to locate the nearest free parking, so I can arrive on time and avoid stress. By focusing on the underlying jobs rather than a product category, you uncover hidden opportunities. For the parking example, the true job might be guaranteed on-time arrival, which could be solved by a broader mobility service, rideshare, public transit integration instead of just a parking app. How to use them in class: write down the problem statement on the board. Break students into pairs to interview each other using the JTBD template. Vote on the most compelling problem solution pairs. These frameworks teach you to look beyond superficial ideas and root your venture in genuine customer demand. Market sizing turns a vague notion like big market into numbers you can compare and use for financial models. 1. Total addressable market, TAM, the revenue opportunity if you captured 100% of the entire market worldwide, with no constraints. Formula: TAM equals sum from I equals 1 to n of open parenthesis population, I times average spend per person, I close parenthesis. Example, suppose you propose a premium electric scooter for city commuters. Global cities with greater than 1 million population, 200 cities. Average annual spend on personal micromobility, $300. TAM equals 200 times 300 equals $60 million. 2. Serviceable available market, SAM. The slice of TAM you can realistically serve given geographic, regulatory, or product fit limits. Formula: SAM equals TAM times market segment share. Example, your company can only sell in North America and Europe, 30% of total cities, and only to commuters aged 18 to 45, 60% of city population. SAM equals $60 million times 0.3 times 0.6 equals $10.8 million. 3. Serviceable obtainable market, SOM, the realistic share you expect to capture in the first 3 to 5 years, after accounting for competition and adoption curves. Formula SOM equals SAM times target market share. Example, you aim for 5% of the SAM within 5 years. SOM equals $10.8 million times 0.05 equals $540,000. Why the three numbers matter: TAM shows potential, useful for investors who care about scale. SAM filters for fit, helps you justify focus on specific regions or segments. SOM grounds the financial projection, feeds into cash flow models and valuation. Quick tip for exams: write the formulas first, then plug numbers. Keep units consistent, all dollars, all users, show each step. Graders love transparency. Advanced tip: use bottom-up data, for example agency statistics, industry reports, rather than top-down assumptions to avoid overinflating TAM. Explanation: feasibility scoring models, SWOT, PESTEL weighted scores, numeric thresholds. Feasibility models turn qualitative insights into a numeric score that helps you compare multiple ideas. 1. SWOT scoring lists strengths, weaknesses, opportunities, threats, maximum 5 each. Assign a weight 0 to 10 reflecting importance. Example, strength of proprietary algorithm gets 8. Rate each item on a 0 to 5 impact scale. 5 equals very positive for strengths and opportunities. 5 equals very negative for weaknesses and threats. Compute, SWOT score equals sum over strengths of weight times rating minus sum over weaknesses of weight times rating plus sum over opportunities of weight times rating minus sum over threats of weight times rating. A positive total greater than 0 indicates overall feasibility. The higher, the better. 2. PESTEL weighted scoring, political, economic, social, technological, environmental, legal. Create a 6-row table. Assign each factor a weight that sums to 100%, for example economic 30%, technological 25%. For each factor, give a rating from 1 very unfavorable to 5 very favorable. Compute, PESTEL score equals the sum over each factor of weight times rating. Example, economic weight 0.30, rating 4 gives contribution 1.2. Set a numeric threshold. For example, scores greater than 3.5 out of 5 are acceptable. Putting it together, first run a quick SWOT to see internal and external balance. Then apply PESTEL for macro environmental risk. Combine, overall feasibility equals 0.6 times SWOT score normalized plus 0.4 times PESTEL score. Practical example, a startup wants to launch a plant-based meat snack in Brazil. SWOT strengths, proprietary recipe 8 times 5 equals 40, weaknesses high cost 6 times 4 equals 24, net 16. PESTEL, economic 0.25 times 4 equals 1.0, social 0.20 times 5 equals 1.0, environmental 0.15 times 5 equals 0.75, legal 0.10 times 3 equals 0.3, political 0.15 times 2 equals 0.3, technological 0.15 times 4 equals 0.6, total 3.95 out of 5. Overall feasibility, 0.6 times 16 divided by maximum 40, normalized to 0.4, plus 0.4 times 3.95 equals 1.82 on a 0 to 2 scale. Since greater than 1.5, the idea passes the MBA style cutoff. Exam tip, show the table, weight allocation, and final calculation. Graders look for clear methodology, not just the final number. Explanation: business model canvas as opportunity validation tool. Key components and links. The business model canvas, BMC, is a one-page map that links every piece of a venture. When you fill it out for a new opportunity, you instantly see if the parts fit together. Customer segments: who are you serving? Urban commuters, tourists, university students. Value proposition: why will they choose you? Affordable dockless bikes with app reservations. Channels: how do you reach them? Mobile app, QR codes on bike stations, campus partnerships. Customer relationships: how will you keep them? Loyalty points, push notifications, 24-hour support. Revenue streams: how do you make money? Pay per ride, monthly subscription, corporate sponsorships. Key resources: what essential assets? Fleet of bikes, IoT tracking, hardware, app platform. Key activities: core actions needed. Bike maintenance, data analytics, marketing campaigns. Key partnerships: who helps you succeed. City municipalities, bike manufacturers, local retailers. Cost structure: biggest cost drivers. Bike purchase and upkeep, software development, staffing. How the canvas validates an opportunity. Fit check 1: value versus customer. If the value proposition does not solve a clear pain for the identified segment, the canvas highlights the mismatch. Fit check 2: revenue versus cost. Compare expected revenue streams with the cost structure. A negative gap signals infeasibility. Fit check 3: channels versus partnerships. If you need a channel that you cannot secure without a partner, the partnership block forces you to consider strategic alliances. MBA classroom exercise. Step 1: give each team a raw idea, for example, AI-driven tutoring. Step 2: fill the BMC in 20 minutes. Step 3: teams present one mismatch they discovered, for example, no clear revenue stream. Step 4: class votes on whether the opportunity passes a validation threshold, for example, at least 6 of 9 links are solid. The BMC turns abstract brainstorming into a concrete checklist, making it easy to explain and score during exams. Key takeaway: use the BMC not just to design a business plan, but as a rapid validation lens before you invest time or money. Traditional net present value (NPV) treats a project like a fixed price ticket you either buy today or never. Real options valuation (ROV) adds the option to wait, expand, or abandon, much like a stock option. Standard NPV. NPV equals the sum from t equals 0 to t of c sub t, divided by 1 plus r raised to the t. Where c sub t equals cash flow in year t, r equals discount rate. If NPV is greater than 0, go ahead. If NPV is less than 0, reject. Real option: wait and see. Imagine you can invest in a new battery technology, but you are unsure about market adoption. You have the option to delay investment for 1 year, paying a small monitoring cost, M. Option value equals e to the minus rt times the maximum of NPV later minus m and 0. Option adjusted NPV, OA NPV, equals NPV if you invest now plus option value. Numeric example. Immediate investment. Cost $10 million, expected cash flows $3 million per year for 6 years, R equals 10%. NPV 0 equals negative 10 plus the sum from t equals 1 to 6 of 3 divided by 1.1 to the t, which equals negative 10 plus 14.4, which equals 4.4 million. Delayed investment after 1 year gives higher cash flows $4 million per year because the market matures. Monitoring cost, M, equals 0.5 million. NPV1 equals negative 10 plus the sum from t equals 2 to 7 of 4 divided by 1.1 to the t minus 1, which equals negative 10 plus 18.9, which equals 8.9 million. E to the negative 0.1 times 1 times the maximum of 8.9 minus 0.5, and 0 equals 0.905 times 8.4 equals 7.6 million. OA NPV equals 4.4 plus 7.6 equals 12.0 million. Even though the plain NPV, 4.4 million, is positive, the OA NPV shows a much larger upside from waiting, a crucial insight for MBA case analyses. When to use ROV in exams. When the problem mentions uncertainty, staged financing, or the ability to abandon, show the NPV calculation first, then add the option value with a clear formula and explain the intuition, flexibility equals value. Key intuition, flexibility is a real asset. Ignoring it undervalues many technology-heavy or regulated opportunities. Effectuation versus causation decision-making, principles, exam-style scenario analysis. Entrepreneurs can approach a new venture in 2 opposite mindsets. Aspect: causation goal-driven, effectuation means driven. Starting point: clear end goal, for example launch a $100 million SaaS platform, versus set of available means: who you are, what you know, resources. Logic: predict then plan, market research to business plan to execution versus co-create. Experiment, interact with stakeholders, let the goal emerge. Key principles: effectuation. Bird in hand, start with what you have. Affordable loss, set a loss ceiling. Lemonade, turn surprises into opportunities. Crazy quilt, build partnerships. Pilot in the plane, focus on controllable aspects. Risk handling, minimize risk via detailed forecasts. Versus accept uncertainty, limit exposure using affordable loss. Typical use: industries with stable demand, heavy regulation, large capital, for example pharma. Versus fast-moving markets, emerging technology, limited resources, for example app startups. Exam-style scenario analysis. Prompt: you have $50,000, a background in mechanical engineering, and an idea to build a low-cost 3D printer for schools. Causation answer. State a goal, sell 10,000 units in 2 years. Conduct market sizing, develop a detailed financial plan, secure venture capital, then execute. Effectuation answer. Start with the bird in hand, your engineering skills, and a prototype you can build with existing parts. Define affordable loss, you will spend at most $10,000 on the first prototype. Reach out to teachers, Crazy Quilt, for feedback, iterate quickly, and let the market definition emerge. How to score. Identify which mindset aligns with the constraints: resources, time, uncertainty. Show at least 2 effectuation principles in action. Contrast with a causation approach and explain why one is richer for the given context. Key takeaway for MBA students. You are not forced to pick only one. Many successful ventures blend both. Recognize the situation and choose the appropriate decision-making lens. A quick cheat sheet for exams. 1. List your mains, bird in hand. 2. Set maximum loss, affordable loss. 3. Identify surprises, lemonade. 4. Name partners, Crazy Quilt. 5. Focus on controllable actions, pilot in the plane. Explanation: screening and prioritization criteria, scoring matrix, cutoff scores, sample exam question. When you have dozens of ideas, a systematic screening matrix helps you pick the handful worth deep work. 1. Define criteria, choose 5 to 7 factors that matter most for your context. Example set for a tech startup incubator. Market size TAM, weight 25%. Competitive advantage moat, weight 20%. Team capability, weight 15%. Capital requirement, weight 15%. Regulatory risk, weight 10%. Social impact, weight 10%. Execution timeline, weight 5%. 2. Scoring rubric. For each criterion, give a score 1 to 5, 1 equals poor, 5 equals excellent. Multiply by the weight converted to decimal to get a weighted score. Formula: total score equals the summation from j equals 1 to n of weight sub j times score sub j. 3. Cutoff rule: set a minimum total, for example 3.2 out of 5 or a percentile top 20%. Ideas below the threshold are discarded. Illustrative calculation. Idea A: AI health tool. TIA M score 4, weight contribution 1 point. Moat score 5, contribution 1 point. Team score 3, contribution 0.45. Capital score 2, contribution 0.30. Regulatory score 4, contribution 0.40. Impact score 5, contribution 0.50. Timeline score 3, contribution 0.15. Total 4.8. Idea B: niche SaaS. TIA M score 2, contribution 0.5. Moat score 2, contribution 0.4. Team score 5, contribution 0.75. Capital score 5, contribution 0.75. Regulatory score 5, contribution 0.5. Impact score 2, contribution 0.2. Timeline score 4, contribution 0.2. Total 3.3. Idea C: consumer gadget. TIA M score 5, contribution 1.25. Moat score 3, contribution 0.6. Team score 2, contribution 0.3. Capital score 3, contribution 0.45. Regulatory score 2, contribution 0.2. Impact score 4, contribution 0.4. Timeline score 2, contribution 0.1. Total 3.3. The numbers in parentheses are weighted contributions, weight times score. Idea scores highest and would move forward. 4. Prioritization matrix visual: plot total score on the y-axis versus implementation risk on the x-axis. Focus on the quadrant with high score, low risk. Sample exam question: you have 5 startup concepts. Using the criteria below: market size 30%, team 25%, capital need 20%, regulatory risk 15%, social impact 10%, score each concept on a 1 to 5 scale and calculate the total weighted score. Apply a cutoff of 3.5. Which concepts advance? Show your calculations. Answer outline. Step 1. Create a table with each concept, fill scores, multiply by weight, convert percent to decimal. Step 2. Sum rows to get total score. Step 3. Compare to 3.5 and list advancing concepts. Why this matters? The matrix forces you to be explicit about what you value, protects against gut feel bias, and provides a transparent audit trail. Exactly what investors and MBA faculty expect. Key tip for writing the answer. Include the formula, a short explanation of each weight, and the final decision sentence. For example, Concept 1 and Concept 4 exceed the cutoff and are recommended for deeper validation.